Hi everyone, and welcome to the second of a new series of videos on KKC. I'm Ian Anderson, a director in our European Direct Lending Investment team, and today I plan to speak on the following topics. Firstly, KKC performance update. Secondly, we'll deep dive into KKR's European Direct Lending Platform, or EDL. Thirdly, we will dig into the EDL portfolio, look at how it is invested to date. And finally, we want to talk about the opportunities that we've seen year to date in 2020 for EDL. In the first video in this series, Jeremiah Lane, a partner in our US credit business, discussed the historic performance of the KKR Credit Income Fund from both NTA, or net tangible asset, and unit price point of view. It has been KKR's aim since the beginning of the year to narrow the gap between KKC's NTA and its unit price. And we believe this can be done through strong performance of NTA, consistent distributions within the target yield of 4 to 6% per annum net of fees and expenses, improved transparency on NTA reporting, and more frequent high-quality communications with investors. When we spoke to you last time, the discount on NTA was about 15%. As you can see on the chart here, the gap has now narrowed down to 12% as at the 11th of November. While we appreciate there's more work to be done here, and we are focused on implementing the restructure of the investment in the GCOF fund that we discussed last time. To recap, this fund restructure would allow KKC to separately hold the GCOF assets in its own account, with the main benefit being the ability to buy and sell investments directly and create access to cash outside predefined windows, providing increased liquidity for KKC. For example, one possible outcome from this is that KKC could be able to distribute income from the GCOF assets on a monthly basis instead of the current quarterly schedule. KKR's European Direct Lending Fund, or EDL, had its final close 2 months ago on the 18th of September 2020. The performance of EDL is included in KKC's NTA, and it has made a positive contribution of 70 basis points as at the end of September. KKC's first capital call from EDL has already been made, and this was funded by KKC's liquidity facility. As EDL comprises illiquid direct lending assets, these assets, and therefore the EDL fund, are priced on a quarterly basis, and the updated EDL performance will be reflected in KKC's final NTA each quarter. Having had the milestone event of closing the fund, I wanted to spend some time describing our EDL investment philosophy, our platform, and our team composition. To sum up the strategy in one sentence, it is: KKR seeks to be the sole or lead lender by providing senior secured capital to established mid-large cap European borrowers across stable industries. Digging into these points in a little bit more detail, number one, the sole or lead lender. This is the ability to drive terms in the documentation by being the one counterparty that is negotiating the transaction. We maintain close relationships with the borrower as we are the sole lender, and we control the decision making if there is an adverse event. We refer to this influence as ball control. The second point on senior secured capital. Our focus in EDL strategy is to be the most protected investor in the business's capital structure, i.e. first dollar out. The EDL fund will have a minimum of 70% of its portfolio as first lien senior secured investments, and we stand at 94% today as we are invested. The third point is mid to large cap borrowers. The focus for our strategy is to lend to businesses which have a minimum EBITDA of about 25 million euros or $40 million. Generally, we focus on the 50 to 100 million EBITDA range, and these businesses would have a valuation anywhere between 400 to 500 million or in excess of 1 billion euros. We believe that larger borrowers in this range will typically have better diversity within their business and more attractive overall credit profiles, and therefore produce better risk-adjusted returns for our investors. The focus is on Europe. We mainly target borrowers in Western Europe, such as UK, Ireland, France, Germany, Nordics, and the Benelux region. And we have a 10% limit for non-European Economic Zone countries built into the mandate, so that's not a core focus for us. The main theme of our investments are focusing on non-cyclical, stable industries. The investment focus is on the stronger, stable businesses which have defensible market positions and our investment committee prefer sectors that can generate consistent and predictable cash flows. The largest exposure per sector in our portfolio at the moment, for example, is insurance for this very reason. Very stable businesses get paid annual premiums. One other thing I'd like to mention here is the importance of the relationship between KKR and the private equity sponsor. The majority of EDL's investments are with borrowers that are backed by private equity sponsors, and we like the alignment of interest here as we are invested alongside a sophisticated professional owner of business. There is alignment of interest for an exit, and if a business underperforms, for example, through COVID disruption, there is a good pool of additional capital that can provide equity support alongside when required. We saw the importance of this through 2020, for example, with some private equity sponsors being able to provide liquidity buffers or capital injections to the borrowers in certain COVID-impacted circumstances. This could be seen across KKR's broader credit platform and not just in EDL. The relationship with the private equity sponsor is not just transaction-based. Our team builds and develops the relationships with these private equity sponsors where we source alongside them for new investment opportunities, and we are ready and able to underwrite investment opportunities alongside them on a faster basis. We find this brings real repeat business, and when we get into the documentation, allows us to negotiate slightly advantageous terms versus what might be available in the broader market because we get first mover advantage. As investment manager, we believe that the inclusion of EDL into KKC will bring the benefits of higher diversification across issuers, PE sponsors, sectors and geographies. Also, as the assets in EDL are priced quarterly, we believe it will bring some stability into the fund NTA. KKR's direct lending platform is one of the largest operating in this segment of the market. The team structure is set up to allow KKR to see attractive deals from across all geographies in Europe. There are currently 27 private credit team members across Europe, and this team is spread across our geographies to suit the different legal regimes, languages and customs that we see. We cover all the main countries in Western Europe, including UK, France, Germany, Italy, the Nordic region and Ireland, with local professionals. It is important for our originators to be in the deal flow and on the ground to be able to source opportunities. Therefore, they are regularly meeting management teams, spending time with sponsors and meeting more and more potential borrowers to source the best investment opportunities. This allows us to get in early and get a first look at transactions. Having diverse points of view and background is not only important for the origination team, but also for the investment committee. Our EDL investment committee is headed by Matthew Boulanger and Dan Petersak, the co-heads of our global private credit business, as well as two other partners, Eddie O'Neill, who's the head of our European leveraged credit business, and Blaine McDougall, the head of our dislocation opportunities business in Europe. Each of these members has significant investment experience, and the average years of experience across the four is over 20 years. Aside from the individual experience, our overall platform has significant experience as we started investing in this strategy in Europe in 2012. We've now made over 60 investments over this period, and we're currently averaging at about 12 a year. The team is established and has experience across sectors, geographies, and most importantly, in investing through cycles. This strategy has grown significantly since 2012, and we now have $5.7 billion or 8 billion Australian dollars in firepower to invest in EDL deals across the EDL fund that KKC is invested in and our other pools of capital. This allows EDL to be the sole or lead lender to the big businesses that we described a moment ago. Focusing on the EDL fund itself, it has $1.3 billion of firepower, and the KKC fund comprises 21% of the total buying power of our European direct lending investment strategy. Other investors alongside KKC in the investment strategy include KKR's balance sheet, pension funds, insurance companies, and other KKR affiliated vehicles. It is quite important to emphasize that each investor in the EDL strategy has a pro rata share of all assets in the fund, and this brings significant alignment of interest across KKR and its investor base. Year to date, EDL net employment is 34%, which is ahead of schedule, and we're very pleased with this. We will continue to give updates on deployment in KKC's monthly report. If we move on to page 8 and we look into the EDL portfolio in a little bit more detail, we have 6 charts here of the business. The portfolio itself, despite only being a third ramped, has diversification across sectors, sponsors and geographies. If you look at the top left charts, you can see that 94% of the portfolio to date is invested in senior secured instruments, i.e. first dollar out, compared to that 70% target. On the next chart, you can see that KKR has been the sole lead or the co-lead lender in over 2/3 of our transactions to date. So we maintain bold control and we are negotiating these transactions which best suit the business and ourselves. On the bottom left-hand side, you can see that 3/4 of the deals have been with borrowers who have an EBITDA in excess of 50 million. So targeting that large scale business. And if you look at the charts on the bottom right, you can see that we have both good sector diversity and good geographic diversity. Our leading sector at the moment is insurance, which we view as very stable. We also have reasonable exposure to retail here, but these are businesses where they are downside protected. One of our retail investments is a discount retailer, which is very strong at withstanding cycles, and they actually grow quite nicely. And another one is in B2B retail. Another point is we participated in our platform in the largest unitranche done in the market to date in Europe, which was a 1.6 billion sterling unitranche where we were the co-lead investor. Performance has been positive for the EDL fund in each quarter of this year, and we'll continue to update the KKC investors as this progresses. Moving on to the next page, we'll discuss the opportunities that we've seen year to date for EDL in 2020. And there are two main themes throughout this year. The first one is during periods of excess volatility during the year when COVID impacted the markets in Q1 and Q2, the EDL fund was able to invest about 8% of the portfolio into high quality syndicated first lien loans that were deals we knew very well and were recommended to the investment committee previously. We worked very closely with our public credit investment team in Dublin, and all of these assets were very well known to the broader credit platform within Europe. During COVID, these first lien high quality assets traded off quite steeply as was a liquidity shortage in the market, and the EDL fund was able to step in quickly and buy these assets in a very short period of time and recycle out of those assets within about 4 to 6 weeks. We made on average a 1.12 return over a very short space of time, which was very attractive for the senior secured loan space. While investing in broadly syndicated loans is not really a focus of the fund, the majority of these assets were names that the private credit team had looked at and conducted diligence on before. So we knew these businesses very well and were able to move quickly on the back of that. Typically, these deals had already been looked at and were brought to the syndicated market, and therefore, as they were publicly traded, we were able to invest and lean into that market quite quickly. The second main theme we wanted to touch on is as markets were slightly dislocated during the year post the main COVID wave, we found there were substantial opportunities for our credit funds to lean in to providing liquidity to high quality businesses. This is where we did some privately placed add-ons during the year. So some of the investments that we did this year are actually privately placed add-ons which sit alongside the larger syndicated loans that the KKR credit team in our public side know very well. These add-ons were sought by borrowers for either opportunistic M&A war chests, so leaning into times of crisis, or to provide additional working capital buffers to bridge any COVID disruptions. These add-ons that we invested in during the year were priced at very attractive economics at yields of 8 to 9%, so higher than our European direct lending typical yields, and also higher than the pari passu syndicated loans that were outstanding for the same issuers. These borrowers were large-scale businesses and they had an average EBITDA of 190 million. And we feel that these are very high-quality risk-adjusted returns for the portfolio. So to sum up, there are a couple of high-level points that we hope have come across over the past few minutes. Number one, KKR has a large, established European direct lending platform with an experienced and multilingual team. Our focus on direct lending is in the larger end of the middle market. We believe that there is less competition in this space and it offers opportunities for better capital preservation. We continue to focus on maintaining bold control when negotiating economics and documentation by being either the sole or the lead lender to these businesses. We're very pleased with how the EDL fund has weathered the COVID volatility through Q1, Q2, and there are no names currently on the EDL watch list. In addition to this, we were able to take advantage of significant opportunities arising from COVID through the year, and we continue to seek out bespoke financing solutions for borrowers where KKR can be the sole lead lender and lead the terms in negotiation. Performance of the fund has been positive in each quarter this year, and we believe the inclusion of EDL into KKC is beneficial as a diversifier of issuer, sector and geography, as well as providing a significant volatility dampener to KKC, given that the assets in EDL are priced on a quarterly basis. Thank you very much for your time today. We hope you found this interesting, and we will speak to you again very soon.